Good morning, everyone. All right, so I hope you have all recovered from the second midterm that we had last week. Overall, the scores were good. I think the average in the class without the quiz grade was about an 80. And I posted all of your grades on Blackboard. For any of you who took the exam late, I think one or two of you took it after the test time. You were having connection problems or whatever the situation was. You should be seeing those grades appearing shortly as well, okay, later on tonight. So, all right, so let's move forward from here. This week we are only meeting on Tuesday, which is today. And then we are not going to be meeting again until next Tuesday. And next Tuesday actually is beginning of December. So we just have a few more classes left, but we're in very good shape. I just wanted to remind you, and I posted it on Blackboard on the announcements, that our final is going to be on, do I have the information with me? I post the information for the final on Blackboard. Okay, and actually the final is going to be for a 2-hour period. I think it's from 11 till 1 or 11:45 till 1. 45, whatever was indicated there. So what the department has basically been endorsing or enforcing is that the final is going to have 52 multiple choice questions. Okay, and you're going to complete them in a period of 2 hours. And they're going to be, a significant amount of them are going to be calculation problems. Okay, and what I'm planning on doing is we are going to go over chapter 17 today. Then we're maybe going to get through the homework for chapter 17 as well, which is attached to this file. And then we basically have one chapter left, which is chapter 21. And then we have to go over, chapter 21 is a significant chapter. It'll take about a class and a half to cover that. So probably next week we'll be covering that. Then after that, we're just going to spend our time reviewing. There are a few ratios, actually, for chapter 14, which is, excuse me, the last chapter on the syllabus. Chapter 14 is just a couple of ratios that you need to know. Okay, you don't have to go through the whole chapter, so I'll tell you specifically which pages you need to know. A lot of it is a review, calculations that we've gone over before or you've gone over in your accounting studies. So we're moving towards the end of the semester. Remember that you still have your sorry about that. You still have your final ahead of you. Okay, you could still get your homeworks in. Okay, so this is not the time to basically say, okay, I give up. This is the time to really dig in and move forward. Okay, all right, so now I see Joshua has a comment. I just want to make sure that the exams and the X are factored in with total score of 100, because Blackboard averages our quiz grades out of 10. Yes, so Blackboard, the quizzes are out of 10. Okay, and the exam is, I have to basically enter the information for the adjusted grade for midterm number 1 and midterm number 2. I do have to say that the maximum grade can be 110 because some people did get above 100. So while it says the grade, the adjusted midterm grades are out of 110, I'm basing it out of 100 and I'm basing it out of 100 points. Okay, and obviously there were a few of you who scored above 100 on when you combine the quiz grade and the midterm grade together. Obviously that would be the A+. Okay, so anything in the high 90s and above is going to be an A+, and I'm going to consider the adjusted grade really out of 100 rather than out of 110. Okay, so yes, so 94 is absolutely considered an A, you know, leaning on A+ if you have that combined grade, Joshua. Okay, and it's just, again, that's just a function. I can't say combine the two scores for the adjusted midterms and say they're out of 100 because there were people who got above that grade. Okay, so I hope that answers your questions. All right, so if no one has any further comments, I am going to move ahead with the slides for chapter 17. Okay, so remember, in Chapter 17, we're still dealing with management accounting. Okay, and management accounting, again, is for internal use. Okay, and Chapters 16, 17, and 21, okay, deal with cost accounting systems. Okay, and when we talk about cost accounting systems, remember that they basically look at a manufacturing operations processes. Okay, and again, manufacturing operations have much more complex financial statements than a merchandiser would. Okay, just due to the fact that their business is much more complicated because they're actually taking the raw materials, the direct labor, the manufacturing overhead, and then passing it through the 3 inventory accounts. Okay, remember that whenever we're dealing with a manufacturer is going to have 3 separate inventory accounts on their balance sheet. Okay, just as a little prep, I'll be quizzing you throughout these last classes. What are the 3, guaranteed a question on the final, what are the 3 inventory accounts on the balance sheet of a manufacturer? Who remembers the 3 inventory accounts? Direct materials, excellent, Francesco, that's the first one, Francisco. Christian Lee, work in process, perfect. And then the last one is finished goods, excellent. Christian and Danielle, Francisco, very good. Okay, and remember that's actually the direction that that the costs flow in. Okay, very good. So those are the 3 inventory accounts. And remember also that the work in process inventory accounts. The work in process inventory account includes direct labor, direct material, and manufacturing overhead. So we're going to keep building on that basis. Okay, what we learned in Chapter 16, we're going to continue building on for this chapter. Okay, and again, why do we have these cost accounting systems in place? Basically, it's to assist management in decision making. Okay, that's why we have these cost accounting systems. Okay, they're basically used internally only by management, and they're used for decision making. Okay, because unless a manager, a supervisor really knows what the costs that are being generated in production are, there's no way they're going to be able to control those costs. Okay, what we're going to be dealing with in this chapter, okay, is basically a job order costing system. Okay, and this is very specific again to manufacturers, and actually I take that back, services firms can use a job order costing system as well. Okay, but when a job order costing system is used, what you have to keep in mind is that each job must be unique. Okay, so when we use a job order costing system, each job is unique. Okay, and again, I always use like a doctor, a dentist, even a lawyer, okay, or a manufacturer who manufactures, let's say, dining room tables. Based on whatever their customer needs are or their patient needs are, that's basically the work that's going to be performed for that customer. Okay, so it becomes very important, okay, when each job that is being performed by the manufacturer or by the service provider, if each job is unique, it becomes very important that they're able to track the amount of costs that are being consumed by each job. Okay, so that's what we're looking at here in this particular chapter. Okay, and again, when we're talking about jobs that are being performed, the jobs must be significant enough. Okay, it has to be a large job that's being performed so that it justifies tracking all of the product costs assigned. Okay, so here again, we're tracking product costs, okay, assigned to a job. And again, management uses this information not only just to gauge production, but they also use these cost accounting systems really to reward and monitor employee performance as well. Okay, and remember, as these costs flow through the inventory system, they're going to be tracked by the underlying accounting systems or cost accounting systems. Okay, remember, as I mentioned earlier in the semester, for those of you who plan on going forward in accounting, there is one semester specifically that is dedicated just to cost accounting, and it is such an important function and area of specialty. All right, and now just because we've been tracking Apple stock over the course of the semester, just to continue that, we want to be consistent till the end. Last time that we were together last Thursday, Apple was trading at $119.51 per share, and again, we've seen a bit of a dip to $113.52. Okay, so Apple and some of those tech industry stocks have been taking a bit of a dip. Okay, 113.53. Thank you, Kareem. Recently, over the last few days, again, because of the instability, because of the rise in coronavirus numbers, again, so that gets reflected in the stock market. If you look at the headlines, it seems the stock market in certain sectors is trying to advance. And again, now that basically the election has been conceded to Biden, at least partially, you'll see that there's going to be more stability again when they start to get more policies in place that are going to support people who are affected by the coronavirus. So interesting time to track what's going on in the financial world. Again, you're going to continue doing this, okay, in your studies going forward. Okay, so what are the objectives? Why do we bother with cost accounting system? Who cares? Remember, if you're a manufacturer, okay, or even a service provider, okay, and you're providing unique jobs to your customers, it's very important that you're able to determine what the unit cost per item is. Okay, because the unit cost, again, what is that going to do? That unit cost is going to be used as a basis for your sales price. Okay, if you're not accurately ascertaining what your unit cost, what it's costing you to produce one unit, okay, of your inventory or your service, you're not going to be able to price it correctly either. Okay, and that means you're not going to be generating possibly enough gross margin, and then finally enough net income. Okay, so what we're going to be seeing when we're looking at these job cost systems is that the unit cost becomes very important. Okay, and again, when we talk about cost accounting systems, remember it's used not just for looking at historical information. Cost accounting deals with planning and cost control functions in the future as well. Okay. And again, it's much more cost accounting systems. The information is not as precise as financial accounting, right? Because we're not just relying on the past, okay? But it also, because of that, it has to be more timely. Because if you're making decisions on a day-to-day basis, you want as much accuracy as possible, but it's also really important that you have timeliness, okay? So that you can make good decisions quickly. Okay, based on useful information, obviously. Okay, so job order costing, again, that's really what the focus of this chapter is. Okay, so job order costing is used by corporations that tailor their goods or services to the specific needs of individual customers. So again, when you see job order costing, that means each job is unique. Okay, so if I'm a builder and I'm building 100 different homes, again, not in a development where every house is the same, but basically, let's say scattered throughout Queens and Long Island, and every house is unique, it becomes important that myself as a builder track the cost, the product costs that go into each home. Okay, again, the product costs, which we learned in chapter 16, include direct materials, direct labor, and manufacturing overhead. And remember, when we talk about product costs, we're talking applied manufacturing overhead. And we're going to spend some time later on this chapter really talking about the difference between applied manufacturing overhead and actual manufacturing overhead. But the cost that's assigned to a product, okay, is always going to be applied manufacturing overhead. Okay. So now when we talk about jobs, okay, on a job by job basis, basically it means that we're filling an order for a particular customer, okay, and it has specific requirements. Okay, because of the fact that it's unique, it's a specific customer with specific requirements for that job. Okay, so that's why it becomes extra important. We track and predict the costs. Okay, and again, if a job contains multiple items of a product, okay, what you're going to do is take the total cost of the job. After you complete the job, you're going to take all of the product cost, direct labor, direct materials, manufacturing overhead, and you're going to divide the total cost by the number of units, and that's going to tell you what the unit costs are. Okay, so total costs. Okay, whenever we're using a job cost sheet, we're going to always remember that total costs per job divided by number of units produced, divided by number of units produced. Is always going to give us cost per unit or unit cost. Okay, and unit costs become very important, okay, not just for the current job, okay, but for any future jobs that this corporation is going to want to price out as well. You're always going to rely on whatever the unit price was on a previous job to bid on future projects as well. Okay. All right, so for job order costing, who uses a job order costing system? Okay, basically in the construction industry, you know, if you're constructing, let's say, a building versus a garage, the type of costs you incur are going to be very different. Basically, the cost per unit are going to be very different. Shipbuilding, motion pictures, each of the jobs undertaken in these particular industries are all very different. Okay, so the costs must be tracked, specifically the product cost, to figure out the total cost of each job. Print jobs, you know, if you're submitting jobs, basically invitations versus flyers that you're going to distribute by hand, you know that the cost of each job is going to be very different based on the quality of the paper, the degree of printing that has to be done per page, etc. Okay, custom furniture makers, again, automotive repair, you know, anybody who goes into a garage typically for repair to their car, each job is going to be different because something different happened to the car. Okay, so again, it's very important. Even if you think about, you know, when you think about going into a automotive repair shop, you think, well, they're not really keeping sophisticated cost systems. They must be in order to survive, okay? And again, that's why businesses don't basically survive or don't stay profitable for periods of time. They're not adequately costing what the price of their jobs are. Okay, even and you can see here we're talking about manufacturers in the first section, the different users of job order cost systems. But here now, look, even service firms. Okay, even service firms such as law and accounting firms, medical practices. Okay, service firms also. Okay, must use job order costing systems. And why? Because basically every single job that they do is unique. Okay, and they can't price it standard. Now, all right, what's the opposite? Okay, what's the opposite of a job order costing system? Okay, the opposite of a job order costing system is called a process cost system. Okay, in the process cost system, okay, each job is the same. Each unit price is the same. Okay. So in a process cost system, so let's say here each unit price is the same. Okay, let's say if we're manufacturers of paint. Okay, if we basically are manufacturers of paint. Okay, you know, in its most simple form, if I'm going to basically manufacture 1 gallon of paint, 1 gallon of paint, except for the color that I put in, is not going to be different from the next gallon of paint. Okay, if I'm manufacturing the same item over and over again, okay, again, the cost per unit is not going to change. I'm just on a production line, and basically the cost of any job is just going to be based on how many units I sell. Okay, so in a process cost system where I'm basically each unit is the same, so therefore each unit price is the same, I don't have to worry about capturing the cost for every single job. Okay, it does become important though when you have jobs of a significant cost, okay, that are basically going to be unique. Okay, so for our purposes, we're going to be focusing on job order costing systems. Okay, but just keep in mind the opposite of a job order cost system is a process cost system. Okay, and that's basically when you're manufacturing the same item over and over and over again. And again, the example I always use is, again, paint, or if I'm manufacturing an item such as this. If I manufacture items of these markers, and I'm just basically adding different colors to them, I know that whatever price, whatever unit cost is, it's going to be the same for each unit that I'm manufacturing, because I'm manufacturing the same unit over and over. I don't have to establish job order costing systems because I know what my unit price is. So basically, I know that for each customer, the price I'm going to charge them is based on the number of units that I'm selling to them. Okay, and I know the related costs as well. All right, it becomes more difficult when each job is unique. Okay, now, question. Now we're going to start talking about manufacturing overhead a little bit more in detail. Okay, so everybody ready? Remember, when we looked at the manufacturing overhead general ledger account, okay, this is manufacturing overhead. All right, remember that I always told you on the left-hand side of that general ledger, whenever we debit the manufacturing overhead account, we are debiting it for the actual manufacturing overhead costs. Okay, whenever we credit the manufacturing overhead account, we are crediting it for the applied overhead. Okay, and again, when we talk about applied overhead, we are crediting this account, the manufacturing overhead, and we are also debiting the work in process account. Okay, so when we apply overhead to our jobs and we're using job order cost systems, we're always crediting the manufacturing overhead, and we're debiting the work in process account and crediting the manufacturing overhead. Okay, now remember, manufacturing overhead, what are some of the actual costs, okay, that are debited to manufacturing overhead? Who remembers? What are some of the actual costs that are debited to manufacturing overhead? Again, this cost is incurred in the factory environment, and it's not direct labor, and it's not direct materials. All right, so what are these costs? Any suggestions? Okay, remember machinery depreciation, factory depreciation is one of them. Very good, excellent. Supervisor labor, excellent. Factory rent, remember, always add factory ahead of that, okay? Joshua, because if it's rent for the administrative offices, it's not considered manufacturing overhead. Factory rent. What are some other suggestions? Security guard. Lysander. Security guard in the, that is in the manufacturing facility. Okay, so security guard in the factory, not in the main offices. Indirect materials, excellent, Christian. Factory utilities, excellent, Manpreet. All right, so any cost that is not direct materials, direct labor, and it's incurred in the factory, all of those costs are going to be debited to manufacturing overhead as an actual cost. Okay, then what happens is on an interim basis, that is at least once a month, what's going to happen is that there's going to be a journal entry that is going to apply that manufacturing overhead, okay, to the work in process inventory. And that journal entry, again, when at least once a month, is going to be a debit to the work in process inventory account. Okay. And it's going to be a credit to the manufacturing overhead. Okay, so if I ask you, which I will, on the final, which costs are applied? Okay, everybody, listen. Which KC, very good. Supervisor salary, very good if they're in the factory as well. But and if I ask you which costs are applied to the product to manufacturing overhead, I'm sorry, to the work in process inventory, which costs is it applied manufacturing overhead or actual manufacturing overhead? Which costs are charged to the work in process inventory? Remember, Lysander, Francisco, excellent. It's always applied. Okay, and we're going to talk now, very good, Joshua, about why. Okay, now the first question, why don't we just apply the actual overhead cost to the products during the year? Why do I have to apply it based on estimates? Okay, and the reason is we don't know the total overhead costs. Okay, we don't know what the total overhead costs are basically that are incurred in the factory until the end of the year. We don't know what the total of all the machinery depreciation, the factory rent, factory security. We don't know the total of all of these costs for this year, okay, until the end of the year when we're able to get the total, okay? Also remember that we might be, remember that if we're basically producing jobs that are each unique in nature, that is, each job is different. Basically, we're going to have jobs of different sizes, okay? And typically what happens is if you have a larger job, typically you're going to assign more manufacturing overhead to a larger job, okay? So since the manufacturer's products and services are not equal for each unit they produce, okay, if they produce, again, if they're constructing a building versus a garage for a private house, you know that the size of the job is different, so you know the amount of manufacturing overhead is going to be different. So how are we going to figure out, how are we going to apply that manufacturing overhead to all of these different jobs that we undertake over the year, but these jobs are all different sizes? Okay, so how do we apply this total of all the actual manufacturing overhead? How do we apply it to all of our different jobs during the year? Okay, and the answer is, is that we're going to use the applied manufacturing overhead. That's why we don't just say, okay, the actual overhead for a particular month, for the month of November was X. Let's just apply this manufacturing overhead to all the units we produced in that month. Okay, that's not going to be good, because if you're producing similar units, you don't want to price them differently, whether you produce them in January of the year or you produce them in November. Okay, so what are we going to do? We're going to have to apply the manufacturing overhead, okay, with some type of rate. Okay, we're going to have to figure out at the beginning of every year, Okay, how are we going to apply manufacturing overhead to all of our jobs? Okay, now remember, we don't know what the total of the actual manufacturing overhead is, right? We don't know the total till the end of the year. Okay, but we can't say to our customers, you know what, we don't know what our product costs are going to be till the end of the year, so we're just going to charge you for the direct labor and the direct materials now. We're not going to charge you the manufacturing overhead till the end of the year. You can't charge your customers that way. So what do you have to figure out? A company has to estimate at the beginning of the year what their applied overhead rate is going to be on all of their jobs for that year ahead of time. Okay, so that manufacturing overhead rate is estimated at the beginning of the year. Okay, so again, now, how do we estimate the amount of overhead? Okay, so basically what's going to happen is we're going to estimate an overhead rate at the beginning of the year, and then over the course of the year, as we produce products, okay, we are going to assign the overhead based on that rate. Okay, so we're going to assign the overhead based on that rate that we determine at the beginning of the year. Okay, so again, how does this happen? This seems pretty complicated, especially if you think of people like a dentist or a lawyer who really don't necessarily have that accounting experience. Okay, that's when they have to bring experts in, or they have to really understand how costs flow in their business. Okay, but okay, whatever rate they determine for their manufacturing overhead at the beginning of the year, okay, they have to apply that rate based on some activity base. Okay, so they have to look, okay, all of these manufacturers have to basically figure out how are these manufacturing overhead costs actually incurred, okay, and what's the best way we can assign them to our products. Okay, so what has historically, when we assign manufacturing overhead to our products produced, typically the basis for assigning those costs after we come up with a manufacturing overhead rate, typically what used to be the way that we would apply the rate to our products is direct labor hours, machine hours, something of that nature. Okay, so and these here, whatever basis we use, whatever activity base we use to apply the cost to our product, okay, that is called the activity base or the cost driver. Okay, so we're going to be talking about this a lot for the rest of the class. Okay, and basically when I refer to a cost driver, okay, the cost driver is the same thing as the activity base for applying manufacturing overhead to the jobs. Okay, so let's take a step back. Okay, let's take a step back. All right, so we know when we're basically producers, okay, when we're manufacturers, we know the three product costs. Okay, so remember the three product costs are direct materials. Okay, and again, direct materials is easy to track, right? Because based on however many units, okay, the number of cars that I produce, I know the amount of direct materials that I use, I'm able to track. Okay, so that's no problem. I can track the amount of direct materials I use for each unit I produce. I can also track the amount of direct labor that I use. That's no problem, right? Because I can look at the employees that are doing direct labor. That is, they're working directly on the assembly line. Okay, and I know they're adding something of value to that final product. And again, I could see their charges, the number of time that is charged on their timesheets. So there's no problem with figuring out the amount of direct materials and the amount of direct labor charged to a job. Okay, the problem comes with the third product cost, this manufacturing overhead. I don't know the total amount of manufacturing overhead, okay, for this year. I don't know the total amount charged to manufacturing overhead for this year until the end of the year. right, when I'm able to total all the costs. But that's not good enough. I have to be able to charge every single job that I do over the course of the year. I have to charge each job a certain amount of manufacturing overhead. Okay, since I can't wait till the end of the year to figure out how much to charge each job, what am I going to have to do? I'm going to have to come up with an estimate. Okay, an estimate at the beginning of the year as to how I'm going to charge all of my manufacturing overhead. Okay, so the estimate is developed at the beginning of the year, and then every time I basically take on a new job, I'm going to have to apply the manufacturing overhead based on that estimate at the beginning of the year. Okay, so I develop the estimate at the beginning of the year, and then as I do production, as I take on jobs over the course of the year, what am I going to do? I'm going to assign that manufacturing overhead based on some activity base. Okay, I'm going to look at the actual direct labor hours on each job or the actual machine hours, okay, or whatever base I'm going to use. Okay, and then again, and I have to use the same base from year to year. Okay, I'm going to look at that activity base on each job, okay, on a job-by-job basis, and that's how I'm going to apply my manufacturing overhead to each job on an estimated basis. Okay, all right, everybody good so far? All right. Now, how do I come up with this rate? How do I come up with my manufacturing overhead estimated rate? Okay. What a manufacturer has to do, okay, at the beginning of every year is they have to figure out what their estimated overhead application rate is at the beginning of every year. Okay. So let's look here. The way we're going to figure out the estimated manufacturing overhead per job is we're going to take at the beginning of the year, we're going to estimate, okay, what our total estimated overhead costs for the coming year are. Okay, so a manufacturer is going to estimate the total estimated overhead cost for the year. Now, if you're going to estimate a cost for the coming year, what do you think the basis for that calculation would be? I'm trying to figure out what my overhead costs for next year are going to be. Okay, I don't know all of my manufacturing overhead costs, but if I've been in business for a while, what do you think the best starting point would be to estimate my total overhead cost for next year? Exactly, Gerson. Excellent. I would use this year's or the last year's numbers. Very good. So I would look at what my total manufacturing overhead costs were for this year. Okay, and I would use that then for a basis to project what my estimated overhead costs for the next year are going to be. Excellent. Okay, so that's where I get this numerator from. The total estimated cost, that's going to be based on the current year. And then I'm always going to add in, well, I know that some of my costs are going to increase, maybe some of my costs will decrease. I factor that all into my estimate, okay? And then what am I going to divide by? The estimated units in my activity base, okay? And remember, this activity base is always going to be the same. Okay, so historically, what have been some of the activity bases that have been used? Okay, total direct labor hours. Okay, total direct labor hours, total machine hours. Total machine hours. Total machine hours, total units produced. Okay. What a manufacturer would do is they would use typically one of these figures as their cost driver. These three numbers that here that I'm summarizing, these are all considered cost drivers. Okay, and you would take what the estimated total cost for manufacturing overhead for the coming year is, and then you would divide it by, well, one. You would divide it by one of the cost drivers that are listed here. Okay, either total estimated direct labor hours, machine hours, or units produced. Okay, and now Joshua, do we need to estimate to a particular value? It's going to be always given to you. Yes, and Joshua, you're always provided this information. Very good, yes. Okay, and then, but you have to figure out, if I tell you what the estimated overhead is for the coming year, the total estimated overhead, and I tell you what the estimated units are, okay, then you're going to have to tell me, how do I apply the manufacturing overhead to the jobs in the future year? So yes, you always have to be provided that. There's no way you could come up to that. And I was just round to the nearest dollar, let's say. Okay. All right. So stick with me. All right. So at the beginning of the year, a manufacturer comes up with their overhead rate for the coming year. Okay. And again, it's total manufacturing overhead divided by the one of these options, either total direct labor hours, total machine hours, total units produced. Okay. And typically these cost drivers here, these three cost drivers, were historically the best cost drivers. Okay. And what is the assumption? Basically, the assumption is, if I use one of these cost drivers, there is a correlation, okay, based on whichever cost driver I choose. Okay, there is a correlation between the way, manufacturing overhead, is incurred. Okay, there's a correlation between the way manufacturing overhead is incurred over the course of the year and the way the cost driver behaves. Okay, so what are we assuming? Whichever cost driver, okay, whichever cost driver the corporation picks, okay, whether it's direct labor hours, machine hours, or units produced, and there's some other popular ones as well, okay, there is always an assumption, okay, that there's a correlation between the way manufacturing overhead is incurred, okay, and the way the cost driver behaves. Okay, so once we come up with this rate, okay, once we come up with this overhead application rate, what are we going to do? That means that if we use total direct labor hours, okay, each time in the coming year a direct labor hour is incurred, okay, we're going to apply manufacturing overhead based on that rate. Okay. All right, so everybody with me so far? This has to happen at the beginning of every year, and this calculation, total estimated overhead, divided by some activity base. And it's whatever activity base the manufacturer selects, okay? But they do believe that there's a correlation, okay? If I looked at a graph, typically, and I was using direct labor hours, okay? If I'm using direct labor hours as my driver, okay, direct labor hours here on my x-axis and total cost on my y-axis, I would expect to see that there's an upward correlation, that the more direct labor hours I incur, or the more actual direct labor hours I incur over the coming year, I would assume that my total manufacturing overhead costs would increase in a similar line. Okay, there's a correlation between the actual direct labor hours and the way manufacturing overhead costs are incurred. Okay, everybody with me? Okay, now when we use some practical examples, you'll see. Okay, now, all right, let's say, everybody stick with me, everybody sit up a little bit higher in your seat, okay? So here we have a corporation named CompuLine, okay? And it's a company that creates software programs. Again, it could be anything, okay? Now, again, assume, and again, Joshua, this is what you would be given, okay? At the beginning of the year, CompuLine's management estimated the amount of overhead for the next year. So this is the total estimated overhead for the year 2019. Okay, 360,000. Then CompuLine's management also has two different comp drivers. Okay, so each of these is a driver, a potential driver of manufacturing overhead costs. Okay, they could either use estimated total direct labor hours, or they could use total estimated lines of code. Okay, they could use either of those as a cost driver. Okay, and now the question is, using these estimates, okay, come up with how the overhead is going to be applied to the jobs that take place in 2019. Okay, so you always know, okay? So let's use the direct labor hours. Let's say we're using direct labor hours as our driver in the first example. Okay, so in the first example, we're using direct labor hours. So how would we come up with our rate? Okay, how would we come up with our rate at the beginning at the beginning of next year? We're going to take the total estimated manufacturing overhead for the coming year. Again, we're given that $360,000. Okay, I'm $360,000. Yes. Okay, and we're told that they estimate that how many hours of direct labor hours for the coming of year. How many estimated direct labor hours are they going to incur? They believe that they're going to incur approximately 30,000 direct labor hours. Okay, again, that's an estimate. Direct labor hours for the coming year. Okay, so using that information, okay, using that information of $360,000 estimated, divide by the 30,000 direct labor hours, they come up with a rate, okay, they come up with a manufacturing overhead rate of $12 an hour. Okay, very good, Kristen and Joshua. Okay, so we came up with a rate now of $12 an hour. And again, this is for 2019. Okay, so now when we basically are pricing a job, okay, this is a job in 2019. So this is job number 1 in 2019. Job number 1 in 2000, oops. Job number 1. Okay, so in job number 1, let's say then, I'll just put 2019 here so it's clear. Okay, so let's say that job number 1 actually incurs 100 actual direct labor hours. Okay, and again, that's not hard to figure out. We just look at the time cards. So let's say job number 1 incurs 100 actual direct labor hours. Okay, how much manufacturing overhead would we apply to job number 1? Okay, in 2019, if it incurs 100 direct labor hours, how much manufacturing overhead would we apply? Okay, what would we do? Okay, how would we figure that out? Very good, Kristen. We would take, we know that 100 hours were incurred of direct labor hours. Okay, so we're going to take that 100 hours and we're going to multiply by our estimated manufacturing overhead rate for the coming year. Again, and it's applied based on direct labor hours. We're going to multiply it by $12 an hour. So how much manufacturing overhead is going to be assigned to job number one? $1,200. Excellent. Okay, so again, at the beginning of the year, they've estimated the amount of manufacturing overhead for the coming of the year. They estimated the total estimated direct labor hours. And then the next year, as you're incurring actual direct labor hours on each job, that's when you're going to apply the manufacturing overhead. That's how you apply it using that driver. Okay, that's as tough as it gets, okay? But remember, you're always going to be told what the total is, and also you also have to be told what the estimated hours or application rate for that for the coming year is for whatever the cost driver. And again, a company, which cost driver are they going to pick? They're going to pick whichever cost driver they believe best reflects how manufacturing overhead costs are incurred. Okay, so again, now let's use this example. Let's go back to the example they have here. All right, so everybody have my information? Oh, you get that from the actual time cards. Excellent, Casey. Where I got the 100 actual direct labor hours. Next year in 2019, as the jobs are actually happening, I would look to see how many direct labor hours, since that's the driver, I would look to see how many direct labor hours were actually incurred. Okay, so I estimated ahead of time, and then when the actual driver is incurred in the next year, that's how you apply it. Great question. And let me go over it again, okay? So here, if we're using, let's go back to the example that they have here. All right, so here, if we use direct labor hours as our driver, again, we're taking the total estimated manufacturing overhead cost for the year, $360,000. We're going to focus on direct labor hours. The estimated amount of direct labor hours for the coming year equals 30,000, and that's the best estimate, okay, that they could come up with. So that, what does that mean? At the beginning of the year, they estimate that as direct labor is charged to each job, they're going to apply manufacturing overhead based on that rate, that $12 rate. Okay, so let's take the example in the book. Okay, so if Compuline wants to use direct labor hours as their driver, okay, so in this instance, they're using direct labor hours as their driver, and they could pick whichever driver they want. They just have to use it consistently. Okay, we know, as we just saw, we're going to take the $360 estimated, and we're going to divide by the activity level of the driver, which is $30,000 for the coming year. So we come up with a rate of $12. So if in 2019, if the actual next year, okay, if a particular job, okay, so if a particular job uses 200 actual direct labor hours, okay, those 200 actual direct labor hours, we're going to multiply it by the $12 application rate. Okay, we're going to multiply it by the $12 application rate. So what are we going to do? That means we're going to assign $2,400 of manufacturing overhead to that job. Okay, and again, what will be the journal entry? Okay, again, we're still debiting manufacturing overhead for all of the actual costs, but then again, when a job is completed, or at least a month, at least once a month, we have to apply the manufacturing overhead to our jobs or into production. So here we would apply $2,400 of manufacturing overhead to this particular job. Okay. Now again, remember, when we were talking about direct labor and direct materials, we knew because we were told how much was actually used in production. The problem with manufacturing overhead is we don't know the actual amount of manufacturing overhead until the end of the year, right? Until the end of 2019. But we can't wait till then to apply the product cost, the manufacturing overhead to our jobs. So what do? We estimate what it's going to be over the course of the year. We have to pick a driver. In this instance, we use direct labor hours. We pick direct labor hours. So as actual direct labor hours are incurred the next year, that's how we assign a manufacturing overhead to each job. Okay, so okay, so what you have to do, all right, so let's do another one. So Joshua, okay, so here, this is how we applied manufacturing overhead based using direct labor hours as our driver, okay? But they didn't have to use direct labor hours. Let's go back to this example, okay? And now let's say that the company decided to use total lines of code, okay? That's the driver they selected, okay, for their manufacturing overhead. Okay, for the year 2019. So we would still look, okay, so now, again, it's the beginning of the year, and we're going to estimate what our overhead application rate is. Okay, so Shamia, so since it's all estimated, will it be any of you? Okay, so, all right, so remember, Shamia, excellent point. So here, yes, we're using an estimated rate, okay? We're using an estimated rate, okay, but we're using the actual hours to apply it to our job. Okay, so keep that in mind. So here, so in this instance, if we use lines of code, okay, what are we doing? We're taking what the estimated overhead is for 2019, which is 360,000, and we're dividing by the driver now is lines of code. We estimate that we're going to have approximately 1 million lines of code for the coming year. So, okay, what does that mean? The 360,000 divided by 1 million, 36 cents. Okay, that means that for every line of code, okay, that we basically, that we charge to each job, we are going to apply 36 cents of manufacturing overhead. So those two are basically both estimates, yes. Okay, so Shamia, yes, you're right. These are based on estimates, okay? So now, here, if we use lines of code, okay, if we use lines of code as our cost driver, here, again, we just came up with the fact that our estimated rate is 36 cents by taking the cost, the estimated cost, 360,000, dividing by the estimated driver, okay, which is 1 million lines of code. So let's say a particular job, okay, let's say a job, this is job number 101 in 2019. If that job uses 1,000 lines of code, okay, we know we could figure out how much direct labor, okay, we know how much, we know how much direct materials they used on the job, right? Because we could trace it. So on job 101, we know we can actually figure out how much direct material they use per job. That's actual, okay? We can also figure out the amount of direct labor that they used on that job, right? Those are two actual figures, right? The amount of direct labor and direct material, these are the actual costs. But we have that third product cost, which is such a pain. Because we don't know what it's actually going to be until the end of the year. So we're going to apply manufacturing overhead to that particular job, okay? And we're going to do it based on the rate we established at the beginning of the year, which is 36 cents per line of code. So the 36 cents times the 1,000 lines, and this is actual code, right? This the lines of code, this is an actual amount of code that was basically charged to that job. So here, based on that, this estimate, how much our manufacturing overhead are we going to charge to this job? $360 of manufacturing overhead to that job. Okay, now, all right, so Joshua, I hope that answers your question. Okay, so you estimate the dollar value and the activity level but then you charge it to the job based on the actual level of that cost driver. Okay, and now very good. And then Shamia, your question, excellent question also. Remember that when we have manufacturing overhead, as we're basically incurring all those actual costs, we're debiting manufacturing overhead. Okay, and remember then that as we're applying overhead like we're doing here, we're crediting the manufacturing overhead for the applied. Okay, and your question is, but wait a minute, if I'm using an estimate to apply it, shouldn't I at times, or isn't it common that I would have some type of difference between these two over the course of the year? And the answer is yes. Since you're using an estimate, you're always going to want to, since you're using an estimate, typically there's going to be a variance between how much you actually incurred in manufacturing overhead and how much you applied to your job. Okay, and again, you want the differences typically to be not material, you want them to be immaterial. And at year end, you're always going to have to do some type of adjusting journal entry at year end, because you want the balance. Remember, in this manufacturing overhead account, you always want it to be a zero balance at the end of the year. Okay, so yes, you will have to do most likely an adjusting journal entry because you can't predict it exactly. Okay, but you're going to try to come up with the best estimate that you can for incurring whatever your manufacturing overhead is. Okay, and I'm going to show you what you do with that variance, because typically you're always going to have a difference between the actual and the applied, yes. But you're always going to have to end up with a zero balance at the end. And typically, just so, because you asked the question, typically it doesn't matter if the debit is higher or the credit is higher. Okay, in manufacturing overhead, typically what you're going to do is just charge it to cost of goods sold. If it's not material, the difference is charged to cost of goods sold. That's kind of where you bury it. Okay, but again, if it is material, that means that there's a problem with your job pricing, and you have to look at that a little bit more closely. Okay, so that's it. Okay, you don't know the actual amount of overhead, so your manufacturing overhead is the only product cost. And I'll write that here just to remind you. Okay, manufacturing overhead applied is the only product cost which is estimated and charged to each job, which is estimated and charged to each job over the course of the year. Okay. Manufacturing, again, because we could track the actual direct material, we can track the actual amount of direct labor. What can't we track and assign to the job? The manufacturing overhead. So what do we have to do? We have to estimate how much we think we're going to incur, and then divide it by one of the cost drivers. And typically it's direct, and historically the cost drivers have been direct materials, have been units produced, the number of direct labor hours, the number of direct materials, number of machine hours. Those historically have been the cost drivers we use. Okay, it was particularly in the United States. But what's been happening over time, what's been happening is now that we have a lot of more global competition, and since the environment is much more competitive, basically they're finding that the historical cost drivers like direct labor hours, machine hours, and units produced are not good enough. Okay, they're not precise enough. Okay, so that's where they've been running in problems. That's what, Shamia, what you were asking. their cost drivers within the United States, they have to start using more precise cost drivers because of the fact that those old ones are not as useful, especially since production has gotten a lot more automated as well. Okay, but again, you always have to be given that information. All right, I'm gonna bother with that. Okay, so what drives overhead costs? Okay, so to be a cost driver, there has to be a causal factor in the incurrence of overhead costs. Again, and I was like I was talking about, if I were looking at a graph of the cost driver, this would be the driver, and this would be whatever the total costs. You would expect to see a straight line, okay, or as close to a straight line as possible. That is the more driver units that are incurred, the higher the related costs for manufacturing overhead are going to be. Okay, so again, typically, if you see that the activity base or direct labor hours is increasing, you would expect to see an increase in actual overhead costs incurred as well. Okay, the problem is you don't see that actual change until year end. Okay, if you see that correlation, that means that it's a good cost driver. Okay, whatever you're using here, direct labor hours, and again, direct labor hours worked historically. Direct labor hours was a good cost driver. Okay, when most of the manufacturing overhead costs were related to direct labor. Okay, so if you use like supervisory overhead or the amount of or the machine hours or things of that nature, when there was a lot of direct labor on a per unit basis, you could use direct labor hours as a driver. Okay, but now as manufacturing has gotten more robotic, okay, direct labor hours is not as useful anymore. It has become not a real good cost driver as we've been developing manufacturing operations to be more competitive. Okay. Right, so historically, some of the direct labor hours was the primary driver, okay, direct labor hours. Okay, but now as factories have become more automated, direct labor is less of a causal factor. All right, so Shamia, what would you expect to see if we've been using direct labor hours as our driver and we haven't changed our driver yet? Okay, but we haven't changed our driver. How could you figure out, how would a corporation be able to figure out that the driver they're using is not efficient anymore? That the driver they're using is not really functioning as a good way to apply manufacturing overhead costs. Okay, how would a company become aware that whatever driver they're using, let's say they were using direct labor, how would a company figure out that direct labor is no longer a good cost driver of their manufacturing overhead? What would typically happen at the end of the year when they looked at their manufacturing overhead account? They would have a large cost variance. Yes, exactly. Excellent. Okay, they would have larger cost variances in the manufacturing overhead account. Excellent. Larger cost variances. If companies start finding that their manufacturing overhead, the difference between applied and actual are actually becoming significant, okay, that means that whatever driver they're using may not be a good driver anymore, and they have to look to change the way the underlying cost driver is used. Okay, excellent. So now, currently, again, because of the global competition, what are some of the more useful cost drivers, the better cost drivers that companies use now are things such as machine hours or computer time or required setup. Okay, so companies have had to become more sophisticated in how they apply manufacturing overhead to their jobs. Okay, and this here, when they're using more, when companies use more sophisticated cost drivers, okay, that is called, and this is all you have to know, that is called ABC accounting. Okay, activity-based cost accounting. Okay, when companies relook and they revisit, okay, they revisit their old drivers and they're now using more relevant drivers based on their actual production, such as machine hours, computer time, etc. So the underlying cost drivers change, and that's called ABC accounting. And that's really what cost accounting in that semester in the future, that's what it's based on. How do you change the cost drivers? How do you change production? Okay, because remember, if you're ending up with these big variances at the end of the year, what does that mean? How did you cost your products over the course of the year? You didn't cost them precisely. Okay, so that means that you could be losing money on your jobs because you don't know how much it actually cost you to manufacture these units. Okay, so that's why the cost drivers had to become more precise. Okay, and that the more precise drivers, and again, is through ABC accounting. And ABC accounting, in that process, you have to change your overall system for applying costs. So it's a big deal. It's not something that companies do lightly because they have to re-engineer all of their production. But again, in order to stay competitive, this is something that they must do. Okay, again, and actually when we use ABC costing, you can use multiple allocation bases. So you could use computer time plus setup costs. Okay, and that's all you really have to know. ABC, activity-based costing, can use more relevant. It uses more relevant cost drivers. More relevant drivers, and in fact it can get so complicated that they can actually use multiple cost drivers, okay, to apply manufacturing overhead to their jobs over the course of the year. Okay, and we're going to see an example of that in a moment, using the old cost drivers actually. So all you have to know about ABC costing is that is really what companies are going towards in specifically in the United States. It was actually begun in Japan. That's why in Japan they had much more, that's why there was so much more competition, because they had higher quality products at a lower cost. So now US manufacturers have been trying to catch up with that, and in China as well. They have more sophisticated job costing systems, so they're able to account and track their costs better. Okay, and again, that makes them more competitive. Okay, so the future really is towards ABC. Okay, remember that when we started this chapter, I told you we were going to be looking at job order costing. Okay, in order to do job order costing, all separate, each individual job has to have its own job cost sheet. Okay, each job is going to have its own job cost sheet. And a job cost sheet is just a summary of the cost for each job. It's not complicated. Okay, so a separate job cost sheet is prepared for each and every job. So you would have a job cost sheet for 101, job 101, job 102, job 103. And again, you have to do it because each job is unique. So you have to capture the costs related to each job. So you're going to set up a job cost sheet. Okay, and then once the job is, so what the job cost sheet does, it is basically going to track all the product costs. A job cost sheet tracks all product costs on each job. Okay, so a corporation knows, okay, what's my work in process on this job? How much direct labor, how much direct material have actually gone in? Okay, so here, again, the job cost sheet tracks all product costs on each job. So you know how much actual direct labor is charged to each job, how much actual direct labor, how much actual direct material, okay, and finally, how much actual direct labor is applied to each job, how much actual direct material, and then the third one is how much applied manufacturing overhead has been applied to each job. Applied manufacturing, applied overhead charged to each job. Okay. And then I have a question here. How do you maintain all that information in a big corporation? So what they have to do, this is really how they track their costs in their accounting system. Their accounting system has to be set up so they're able to track all the jobs this way. If they don't, they can't stay in business. Okay, so in their accounting system, they're going to, and it's not difficult because you'll see the journal entries that we already learned, Shamia. The journal entries we already learned. All that happens is that they're also going to be posted to the job cost sheets as well. Okay, and again, their system has to be set up to easily do this. Okay, and again, these are the costs that we're going to be tracked on the job cost system, on the job cost sheet. Okay. All right, so let's look at this job cost sheet. So this, ta-da, is what the job cost sheet is. And again, all it is, okay, when we talk about job cost sheet, it is just a summary of product cost on each job. A summary of product costs okay, and again, this is the way their accounting system is set up. Okay, and that's why, since the accounting system is set up this way, when companies have to change their accounting system, let's say they're going to change the driver that they use because the old driver doesn't accurately reflect how costs are actually being incurred, realize that what a big undertaking it is to change a driver or to change your accounting system. Again, it takes millions of dollars for large companies. It takes millions of dollars because not only are you changing your production, you're changing the accounting for your production as well. Okay, but again, if you don't do it, what's going to happen is you're going to go out of business because you're not able to stay profitable in a competitive environment. Okay, so on each job cost sheet, what is going to be reflected? Of course, you're going to, because it always has to be sequential. That is in sequential number. So this is job cost sheet 831. Okay, here it's going to indicate this is the job cost sheet. The name of the company, the name of the manufacturer is Oaken Glass Furniture Company. And what are they producing? They're producing French Court dining tables. And in this job, they're producing 100 dining room tables for this job. The date the work was started, that is the day they got the customer order, is on January 3rd. And here they completed it by January 21st. So this job cost sheet really helps them run the operations. Okay, so we can see here, so this company, Oaken Glass Furniture Company, they have two manufacturing departments, milling and carving and finishing. Okay, and again, in the milling and carving department, the amount of direct materials that have been incurred were $10,000. So what would be the journal entry for direct material charges that are incurred in the milling department? You would have here work in process, okay, being charged for $10,000. Okay, and then you would be crediting your direct materials inventory account. Okay, for that same $10,000. And then you'd have to have your accounting system set up that you would also be charging the same information on your job cost system, on your job order cost sheet as well. Okay, then here, what else do we know? We know that in that department, they also incurred direct labor costs of $14,000, right? Direct labor costs. What would have been the journal entry then to record direct labor hours charged to this job? again, you would debit the work in process inventory account for the $14,000. And what would you credit? You would credit the direct labor account. You would credit direct labor for the $14,000. Okay, so now we know, and again, it would be posted in your accounting system on this job cost sheet too. It's all automated. Okay, now remember the third product cost. This one is the tricky one, the manufacturing overhead. Manufacturing overhead, remember, is an indirect product cost. Okay, so how would you charge it to your work in process? Okay, we're told here that the overhead rate is 150%. Okay, and in this instance, we could just tell by the amount that was charged here. The manufacturing cost applied is $21,000. We know the rate is 150%, so we know that manufacturing overhead was applied based on what? It was applied based on total direct labor costs. So the $14,000 of direct labor costs charged on this job times the overhead, the estimated, remember this is the estimated overhead rate of 150%. That is how we charged manufacturing overhead to this job. All right, so what would be the journal entry? And again, this would be on the control account. What would be the journal entry then? We would debit work in process for $21,000. Okay, and we would credit manufacturing overhead applied. Okay, for the $21,000 as well. Okay. And then it would update our job cost sheet automatically. Okay, that's the first production department. But look what happens here. There's another manufacturing department called finishing. Okay, and we see that there's direct material, direct labor, and manufacturing overhead cost applied in that department as well. And again, it's important because a company has to know how to track the costs. So their accounting system has to be sophisticated enough to be able to do this. Okay. Now in the finishing department, they know that when they were manufacturing, remember this is for this job, for manufacturing 100 dining room tables, they used $15,000 worth of direct material. So again, that means direct material work in process is going to be debited for the $15,000, increasing that inventory account for $15,000, and then you're going to credit the direct materials for the $15,000. Okay, and again, that is going to update your job order costing sheet. Okay. We also know that $6,000 of direct labor costs were incurred. So just like we did for the other, for the milling department, we're now going to do the journal entry to record all of the direct labor costs on this job. In the finishing department, again, debit the work in process inventory account for $6,000. And credit your direct labor for, and now you're applying your direct labor costs to this job for $6,000. Okay, and then finally we know the last part, the trickiest part, the indirect labor costs. How much? The manufacturing overhead cost, the only indirect cost. How much manufacturing overhead was applied in the finishing department? We know $9,000 worth of manufacturing overhead. Okay, and how do we know that? Because we were told here the manufacturing overhead rate for this year is 150% of the direct labor cost. Okay, so we took the direct labor cost of $6,000. Okay, we multiplied that direct labor cost, all right, by the overhead rate of 150% or 1.50, if I put it into a decimal. All right, so how much manufacturing overhead was applied to this job? $9,000. in the finishing department. So therefore, what was that journal entry for the third product cost? Debit work in process for $9,000. And you credit your manufacturing overhead applied. Or that same $9,000. Okay, and again, your accounting system is set up in order to do it this way. All right, and what's the nice thing about this job order cost sheet? Remember, as the job is ongoing, before it's been completed, this job cost sheet is going to function as a subsidiary ledger. Okay, it is going to show me, okay, basically how much it's going to be a subsidiary ledger. It's going to tell me what costs have been incurred on this job year to date. Okay, how much of all of the product costs have been applied to this job year to date. And I can tell the direct materials used on this job. If I total it here, what was the total at the end of the process? How much was the total direct material applied to this job? I could see 25, I'll just total these two columns. $25,000 in direct material was applied to this job. Okay, how much direct labor costs were applied to this job? I could tell, I add these two together, I could tell $20,000 of direct labor costs were charged to this job. How much manufacturing overhead was applied, excuse me, I would total these two columns, equal $30,000. I would post that total here for manufacturing overhead. Remember, it's applied using that rate. So what was the total cost for this job? The total cost was $75,000. Okay, what was the total per unit cost? The total per unit cost, remember we manufactured 100 tables. So what was the total per unit cost? The total per unit cost was $750 per unit. Okay, and this is the type of information that is gotten from the accounting system and then applied to the job cost sheets. Again, why bother? Remember that each job is unique. Okay, each job that I do is going to be for a different type of furniture. We're a furniture manufacturing company, so I have to capture all my direct material, direct labor, and manufacturing overhead applied. Okay, now it could be, okay, remember this, all of the, when I costed this job out to my customer, remember it was all based on estimates. Okay, so if I basically told my customer, okay, I'm going to charge you $700 per table, that's how much I'm going to charge you. Okay, what's going to happen? I'm going to lose money on this job. Okay, so it's important that these job order cost sheets, again, they capture the historical information on this job, but realize that this job cost sheet is also going to be used in bids on jobs in the future as well. Okay. And this is what a job cost sheet does. And again, don't be overwhelmed. What's happening here? What is the job cost sheet reporting? Just the amount of direct labor, direct material, and manufacturing overhead applied on a job-by-job basis. That's all that this is doing. Okay? Because each job is unique. Don't be overwhelmed. It's easy. You know all these journal entries already. Okay, what's happening here is just you're dividing it now between the manufacturing departments that work on this job. And again, you have to be told all this information. The only thing you wouldn't maybe be told is the amount of manufacturing overhead applied. But again, all you would do is take the rate and multiply that rate by the driver. That's as difficult as it gets. Okay, and you'll see when we do the homework assignments, it's much easier than it sounds right now. Again, these are the journal entries. Okay, these are journal entries we just did. Remember when we incurred direct labor of $52,000? Remember, actual direct labor is debited to, and again, this is actual payroll costs. Okay, that is debited to the direct labor account. And then as it is applied, remember, as direct labor is applied to jobs, you're going to credit that account. Okay, Here, manufacturing overhead. Remember, this is the actual manufacturing overhead costs that are being debited. And then here, when it's applied, which is 150%, right, of what the direct labor cost was, that's how we credit the manufacturing overhead. Okay, and then here, materials inventory. Again, we started out materials inventory. We started out with an opening balance. We add all the purchases for the year, and then we're going to credit it for all the materials that are put into production. Okay, based on the purchase requisitions, etc. Okay, remember, these are the control accounts. These are in total. These are control accounts, but remember that you also, if you're a manufacturer, you're also going to have your subsidiary ledgers. The subsidiary ledgers just basically tell you which jobs, okay, the underlying jobs. It's not enough just to know here what the totals were. You have to know, okay, what makes up the total here for those two jobs. Okay, you have the totals here, and then you're going to have the details as to which jobs were credited here. All right, and again, when you credit direct labor, you credit direct materials, and you credit manufacturing overhead. What is always the debit? You're transferring the cost to your work in process inventory. Okay, and then again, remember, once your work in process inventory is completed, you credit this account, and then you have to debit the finished goods inventory account. This is all the information we learned previously. It's just that now we're looking at it, we're applying the overhead. We're seeing how the overhead is actually applied here. All right. And again, here, remember, on an interim basis, typically at least once a month, at month end, all the materials that are used during the month are totaled and the following journal entry is made. Remember, it's always the same. You're going to debit the work in process inventory, and this is the journal entries we just did. Debit the work in process inventory, credit the material inventory for all the direct materials placed into production. Right, we're taking out of the first materials inventory account, putting it into production, debiting work in process. The direct labor, same thing. As direct labor is applied to the jobs, okay, what is the journal entry? Always debit the second inventory account, work in process inventory, credit the direct labor general ledger account to apply the direct labor to the work in process inventory, to all the jobs that are being undertaken. And then finally, manufacturing overhead. Again, that's when we have to use, remember, direct labor and direct materials are direct product costs. Remember that manufacturing overhead is an indirect product cost. So we have to use a cost driver over the course of the year to apply manufacturing overhead. So we have to remember at the beginning of the year, okay, at the beginning of the year, we have to figure out the predetermined overhead application rate, or POHR, predetermined overhead application rate, or overhead rate, predetermined overhead rate, POHR. And that's exactly what we just did when we took the estimated amount of overhead for the current year, estimated total overhead, and we divided by the estimated activity driver, or the estimated driver. Okay, that's how we figure out the predetermined overhead rate, or POHR. Okay, I know it seems like a lot of details, but I promise you that once you go over the homework and you understand the homework, it's really not difficult. It's everything we learned in the previous chapter. Okay, here, let's just close on this slide. Oaken Glass used an overhead application rate of 150%. Okay, and again, it's 150%, read carefully, of direct labor cost. Okay, so direct labor cost is the driver, 150% is the overhead rate. Okay, here. So what is the summary entry at the end of the month to apply manufacturing overhead? Again, since the direct labor costs were $60,000 for the month, you multiply it by the driver 150%. The total amount of manufacturing overhead applied equals $90,000. So you debit work in process inventory, credit manufacturing overhead. Okay. All right. I think we only have one or two more slides here, but and actually the next slide, Shamia, this is what we're going to deal with when we get together next Tuesday. What happens at the end of the year if we underapplied or overapplied our overhead? Okay, but I'll stop here just because I know we've gone over a lot, and I want you to go, when you are home, for most of you, I want you to go and read your books, read this chapter carefully. Okay, and we're going to continue with the slide on Tuesday of next week. Again, attempt the homeworks for this chapter, okay? And then we're going to continue. We have 2 or 3 more slides just at the end of the year. And Joshua, did you open the exam yet? Yes, I opened the exam, I think, Joshua, but then I closed it because there were few people still taking the exam, but it should be open now. I think I did close it again because I just didn't want anybody, I want everybody to be fair. I want to be fair to everyone. Okay, so I'll open it now at the end. I closed it again. I'll reopen it at the end of this class. Okay. Okay, and everybody have a wonderful Thanksgiving. Stay healthy, stay happy, wash your hands. Okay. Oh, you're welcome, Shamia. All right, and we'll continue with these slides next class. All right, and we're going to go over the homeworks. The homeworks are posted here already. Casey, I know you asked me a question. I hope you're still here. I'm going to submit what you asked me to. I'm just completing that. Okay, don't worry about it. I didn't forget. All right, and everybody, Christian, Gerson, Joshua, Shamia, Manpreet, everybody have a great, healthy weekend. You have a lot of time. You're welcome, Casey. Kristen, start studying, okay? Don't wait till the last minute. There's a lot of review that and we're going to do it together, but also start ahead of time. You too, Rafaela. Thank you. Thank you, Casey. You too.